Good evening, Ajim. I don't expect today much people will join. We will start after 1 minute. And thank you for joining. That's why at least I can start the session uh, with you. If you are gaining something through these sessions, I am loud and clear and my screen is visible, I think. So again, welcome. My name is Shutanu Sadukhan. I am a TA and your facilitator for the weekly live interactive session of week 8 of the NPTEL course code CE86, that is Water Economics and Governance. And we are at the 8th week. So only one session is left for this month. And for the sake of recording, I'll tell one thing. So hopefully you all have filled up the feedback form, I think. Mm, okay. So happy Ganesh Chaturthi and happy Vishwakarma Puja. So Vishwakarma is called as the Lord of the Engineers, right? So the deity is nearer to the engineers. Okay, and the survey form, I think you have filled up, and also I will expect that other to fill up the feedback form. It will not take more than 2 minutes. It will help us to gauge your experience and with the expectation with which you are attending the sessions, and also in subsequent years, in the next year also, and for many years to come, the data those we will collect from your feedback, that will use to modify the course to make the experience of the learner better. Okay, so let's start. So today's session we will mostly cover the time value of money, and related formulas we will see, and we will mostly solve MCQs which is based on various economic theories, and at last we will solve couple of problems just like our previous sessions. Last session we also solved certain problems which were based on uh, benefit cost ratio, BCR, and also incremental benefit cost ratios. So if any doubt on that, I will ask to uh, type your doubt in the chat box, or otherwise we can proceed with our because today I think mostly is what Sir also discussed in his 8th week lectures. That is basically the economic theories only. So this session also we will introduce certain concepts on economic theories only, and also we will solve problems based on those concepts and based on Sir's lectures. And one thing I would like to say is that I hope that whatever the sessions has been conducted till now, so it had been helpful to you for solving the assignments. certain problems. And also I hope that our these the problems those we have discussed and designed, those will help you to clear your final exam in a smooth way. Okay, so let's start. uh, so the time value of money is the concept that a sum of money is worth more now than the same sum will be at a future date due to its earning potential in the interim. So it is based on the concept that the money value increases with time. It is a core principle of finance and economic theories. Uh, why the money value basically increases with time? It is because a sum of money in the hand has greater value than the same sum to be paid in the future. So that's why we see in every sectors where the banking business is there, just like lending money or taking money as a loan or depositing money or investing, everything everywhere we see that though the percentage may vary, there is a certain interest rate associated with it. It is not like that only the value uh, what is taken, only that sum is paid. It is not like that, because money value increases with time. So that's why there is always a percentage which is compounded with the fixed sum of money. So there is a concept that is called the cost indices or consumer price index. So just like in the below table, it is expressed that in the base year or year one, let's say it is 100, year two it is 103, year three it is 105, year four it is 104. Like that way, the price of a equipment or price of a entire project may vary or change. So if it is called, if for example there is a water treatment plant and there is a pump, and that pump, let's say, costs as 10,000 rupees, and you are told that in the year one it is costing 10,000 rupees, and how much will it cost at the year three? So you will just have to calculate the ratio of the cost indices between those 2 years. So which is actually the cost will be directly proportional to the cost indices or consumer price indices. So at the year three, it will be simply 105 divided by 100 into 10,000. So in this way, so it is a kind of representative table or example, you may say. Uh, in this way, the cost indices or consumer prices in price indices are expressed. So the thing is that sometimes some equipment, not only if it is a second hand equipment, if it has been already used in some plant, then the value of the equipment will decrease. Otherwise, if it is newly manufactured, the price may increase. So like that way, the cost in money, though money value increases with time, the cost indices may not increase with time, may or may not, it may decrease also, depending on whether it is already used or not. So there is a formula with which the time value of money is calculated, which is as follows. So future value or FV equals to present value into 1 plus I to the power n. This is just like your compound interest formula, where I is the annual interest rate or required return, and n is the number of years before you receive the money. And the with time the money value will definitely increase. It may increase linearly, it may increase exponentially, or it may increase asymptotically. It depends on the market scenario, and the formula will help you to determine how much money you will have after a given period of time. Let's say n is expressed in years and I is expressed in percentage. For example, there is a interest rate of, let's say, 4% per annum. So if the present value of money is 100, after 1 year it will be 104. It may so happen that the interest is paid quarterly. That means within that year the interest may be paid 4 times. That means for each period the interest will be 1%. In that case, the formula may be modified as follows: the future value of money equals to present value into 1 plus I by n whole to the power n into t. Here n is the time period. Let's say in a year it is quarterly the interest is paid and interest is 4%. Then the number of periods n is basically your 4. So that means your 1 plus I by n, it becomes 4 by 4, 1%, and the number of years gets multiplied with your time period. That means if you are asked to calculate the future value after, let's say, 5 years, then it for quarterly payment it gets multiplied with 4. That means it becomes 4 into 5 equals 20. Or if the interest is paid after 6 months, then it this I by n term becomes 2%, and the n by t term becomes 2 into 5 equals to 10, like that way. So this is your future value of money. We can express the I by n as r and n cross t as a new value of n. So basically n is the total number of time period and r is the your interest rate for that particular time period. So it may be 2 months, it may be 3 months, it may be 1 year, depending on the scenario. So as it was in the left hand side, so I present value is calculated like that way: future value divided by 1 plus r to the power n, where n is the number of periods, r is the rate of return for each period. Now there is a simple concept that is called payback period formula, which is equals to initial investment or original cost of the asset divided by cash inflows. Cash inflows means in each period how much uh, your revenue is getting generated by your asset. So if your let's say you have invested 10,000 rupees in a project, and from first year onwards, uh, for each year you get 1,000 rupee as your profit, then the payback period comes out to be 10,000 divided by 1,000 equals to 10 years. So there is no interest term involved. It is only dependent on the your initial investment value. So what will be the value at the time of the cash inflows, or what is the present value of the cash inflows? Those actually doesn't come into the picture during the calculation of payback period. Now there is basically your the previous concept was present value equals to future value divided by 1 plus r whole to the power n. If you the future value and present value in one side, and the n terms, that is your number of periods, it goes to the above like that way, 1 by number of periods. This becomes 1 plus r. That r is called the internal rate of return. So 1 plus r equals to this value. R means this value minus 1. Why internal? Because during the calculation of this rate of return, the external risk factors or the fluctuations in the market. Uh, these scenarios are basically external factors are not considered. So that's why it is called as the internal rate of return. And if R is the internal rate of return, C is your cash flow for each period, then and N is your capital N is your total number of period, then net present value is related with the internal rate of return with the help of this formula. Actually, at the end of the session, we will solve a similar problem. So, and also because you just have to remember all the economic theory formulas for calculating related problems, answers, and also solving MCQs. So that's why we just briefed all the concepts a little bit at this starting. So now we'll solve MCQs based on what we just saw and also what Sad has discussed in his lectures. So the first MCQ is as follows. The computational method of payback period is option A, estimation of the future cash flows and identification of the duration when it becomes zero. Option 2 is estimation of the future cash flows and subtraction of the future cash flow from the initial cost until the investment is recovered. Option C is addition of future cash flows till a point the total exceeds a preset limit, and option D is none of the above. Uh, so anyone has joined? I don't think so, because today is both your Ganesh Chaturthi and your that is called Vishwakarma Puja. So though main puja was before, but people actually used to fly kites during throughout the all the days. So I don't expect much people to join. So okay, you have given answer option as the option B. So we'll proceed with the answers. So the explanation is as follows. We saw what payback period method basically is. In this method, the computation estimates the cash flow and deducts future cash flows from the initial cost until the investment has been recovered. So option B is correct as you have shared. Now the next MCQ for you. So which of the following capital budgeting methods consider time value of money? We saw what time value of money basically is. It is basically increases with time. The value of money basically increases with time. Nothing else. Now there are maybe percentages. So in the case of capital budgeting method, which of the following uh, considers the time value of money? Option A is discounted payback period. Option B is net present value or NPV. Option C is internal rate of return. And option D is all of the above. So the net present value and the internal rate of return formula we have seen. The discounted payback period, this idea, the discounted thing, we will solve problems later based on that. So this question you can answer based on what Sad has discussed in his lectures. But the thing is that here the economic theory is it is basically you have to remember the terminology. You have to somehow link the name of the term and develop a kind of sense. So what the thing possibly mean. So like that way you can remember the formula. Okay, we are saying as the all of the above. We will proceed with the answer. So the explanation is time value of money is considered in all the capital budgeting methods, because without considering that money value increases with time, you cannot basically develop the formula for the methods. So that's why all of the above, as we have correctly said, is the correct option. Now, there is a problem. So the net present value of a water resource project on rainwater harvesting is rupees 29 lakhs, and the initial cost outlay on the project was rupees 24 lakhs. Don't get confused by the term outlay or something. It is in this problem here it is cost only. Now we have to calculate the PI of the project using BCR method. What is PI? PI is your it is an index, price index, you may say, or yes, it is basically your project index or price index. It is called, and BCR we have seen that it is your benefit cost ratio. So benefit divided by cost. Only this ratio is called as the benefit cost ratio. This is nothing fancy. So you have to calculate that index. So you may not remember how the index is calculated. So we will first tell the options. So option A is 1.2, option B is 2.2, option C is 1.8, and option D is 2.8. So you may not remember. So the thing is that this benefit in the case of benefit cost ratio method, benefit is nothing but your revenue, which is nothing but your net present value. As here it is stated as 29 lakhs. Now the profit index or project index, this value is basically your 1 plus BCR. Now somebody may confuse this benefit as only profit. So in that case, they will just subtract 24 from 29, and they will calculate the value as 5 lakhs, and they will calculate the ratio as 5 divided by your cost, that is 24, and they will sum with 1. So in that case, that will be your wrong. So that's why it is given that benefit here means your total entire revenue, the entire value of the project, which is uh, in the current scenario. So that is your 29 lakhs. So that is your entire benefit. So that means it is not the profit. So it is 29 only revenue. It is not 29 minus 24. So now the problem is pretty simple. Yes. So we have calculated it correctly, I think. Profitability index means 1 plus net present value divided by initial cost. That means 29 lakhs divided by your 24 lakhs, which is your 1.21. That means 2.21, which is approximately equals to your option B. That is 2.2. Okay. So I think today's session will be completed a bit early because nobody has joined. I am not giving much time for the individual questions. So it's good. We will get time because today we didn't get holidays for our because we had to prepare for the sessions, and also you have to attend. You had to attend. Okay. Now the next MCQ is for the independent projects, the internal rate of return and the NPV based assessments would option A lead to same accept or reject decisions. Option B is lead to opposite accept or reject decisions. Option C is may or may not lead to same accept or reject decisions. And option D is independent projects can't be assessed using internal rate of return and net present value. So during one formula we just showed before the starting of the MCQs. So where the relationship was mentioned between NPV and the internal rate of return. So both are you're basically directly proportional to the cash flows. I mean, if you take the terms, if you remember the form, like if you just take the all the terminologies in a single side, then you will see that both are you're basically even inversely proportional to each other, and both are directly proportional to the your cash flows. So and basically how the value of an independent project is determined, whether to accept that project or not. So it is you're determined based on how much cash flow it is generating. As we last class we told, there is a good book of cash flow quadrant. So business actually project is basically your business, and business stands on cash flows. So that's why your the decisions which is to be taken, your actually if it is based on the NPV or whether it is based on the IRR. So if you take any one of them, so I mean during the evaluation of the project, you will come in at the same decision basically. So the NPV and the internal rate of return based assessment would lead to the same accept or reject decisions. So whenever we will solve the problems, so then these concepts will be much more clear. I mean, initially it is. I mean, I also didn't understand why it is saying like that, but during solving problems, this will be a bit clear. So here option A is the correct option, but it is okay. So because here, I mean, unless and until you solve some certain problems based on the concept, so it may not get so much clear. But okay, but you can go through the lectures multiple times, which sir has given. So because economic theories are not kind of intuitive in nature, unless and until you study those the definitions behind the terminology. So those are not very kind of intuitive that we can just answer. So we have to just uh, look at the concepts behind the terminologies and also solve certain problems. Based on that, then it will get clear. So otherwise also while solving problem also you have to remember the formulas. Okay, so at the second up we will solve certain problems. So now the next MCQ for you is the from the calculation point of view, the simplest capital budgeting method is option A is payback period, option B is net present value, option C is benefit cost ratio, and option D is internal rate of return. So benefit cost ratio and incremental benefit cost ratio. Based on these two concepts, we have solved problem in the last class. And these three uh, things, that is NPV, the payback period, and the IRR, we just touched a bit at the starting of the session. So I think during solving the problem, I have said that which looks uh, pretty much simpler among all these concepts during budgeting. Mm, okay. So the thing is that I'll again repeat the thing. The payback period method, basically it is just a ratio of your initial investment divided by your cash flow. So it is just a ratio. There is no compounded kind of thing. 1 plus r to the power n. This is power. Those terminologies are not there. Simply mathematical ratio. This is a ratio, but the other mathematical formulas, these are a bit complicated. The IRR concept is a bit complicated because there is also the power term is there. 1 plus r to the power n. in the in NPV, the concept is there, and also in the benefit cost ratio you have to calculate the individual b by c or delta b by c, depending on what are the benefits and cost of the project of different years. So during solving the BCR problem in the last class, we saw that they are one by one. You have to compare two projects in the BCR method. So there's a large table we had to form, and we had to calculate. So though the mathematical formula is not tough as your NPV and internal rate of return in case of benefit cost ratio, but still the problem, the solution methodology is your it is a bit lengthy. But in case of payback period, you just have to calculate that within how many years you are getting back your money in terms of your cash flows. So P1 project means this many years, P2 project means this many years, P3 project means this many years. Like that way, you have to compare different projects. So the payback period method, it is pretty much simpler in terms of calculation, because in the other budgeting methods, it involves more terms in computations. So in the option B and D, there are the mathematical formula is your complicated because the power is involved. So there may be Taylor series expansion or something like that if the power is very high, and again you have to assume something to uh, ignore the lower order terms. And in benefit cost ratio method, though the method is simple, still the table formation of table, and there are more terms for involved for computation. Though the method is simple, still it is lengthy. But in case of payback period method, it involves actually your lesser terms as compared to the other methods in terms of computation. So that's why here the option A is your simplest capital budgeting method. Now the you have to again match the following columns. So you may get bored until now. So you may apply a bit intelligence, and you may match the columns. You may come up with certain that is called your shortcut methodology for matching columns, like that way, and the teacher may get confused. But uh, though these sessions are not evaluated, so you can do that, but it is not recommended. So uh, you have to do it in our conventional method only. So in the left hand side, there are these terms: the sunk costs, the externalities, and the future cash flows. And the right hand column, the terms are there: cost accounting for additional cash flows of the project, cost that has already occurred and can be part of incremental cash flows, and the third option is effects those investment project has upon other things. I mean this cost affects those investment project has upon other things. I will wait for 2 minutes. This is, I think it will be affects the result. So internal rate of return actually your basically means the cash flow that is related which that is calculated devoid of the external factors. which are financial risks or market fluctuations or maybe natural calamities. When those factors are not considered, then the actually the cash flow is calculated based in all the three cases. Actually, the cash flow is calculated based on that. So it will be effects. I think this is not effects. So I think you have given it correct answer. Okay. So the sunk cost, the A, it is that cost which has already occurred. So that option two. So it cannot be part of incremental cash flows of capital budgeting analysis. Incremental cash flow is the difference in cash flows with and without the project, accounting for additional cash flow that has been realized with the project. Now, this externality is an effect that the investment project has on other things. So this is correct, I think. So there is an investment project. So it has certain effects on other things. So the effects may be positive, may be negative. For example, in certain there is a terminology called as corporate social responsibility or CSR. So that positively impacts, though that is not directly uh, related with the works uh, those are happening within the project or centering the project, but that thing benefits the society. So that is basically your positive effect, and uh, your that is called the negative effects are example is your environmental pollution. So those are the externalities related with the your investment project. The other things are your society at large, your environment. So it has got certain effect on that, though it is not directly related with the project activities. So option as you have said, B is related with 3 and it is correct. Yes. So and the sunk cost is cost that has already occurred and can be part of incremental cash flows. We have solved one problem and we have seen what the incremental thing means basically. So from project to project or from year to year, the cash flow increases or the percentage increases from with respect to the previous one. So that means the incremental. And sunk cost means basically your cost has that already occurred. So A is definitely related to with 2 and B is related with 3 as you have said, and C is C with 1. So future cash flow is cost accounting for additional cash flows of the project. So the additional cash which can be generated or revenue which can be generated for a particular for a fixed periods of time in the future during the run of the project. Okay, so these concepts will be pretty much clear when we will solve the problem at the last. Okay. So now the next MCQ is as follows. If the net present value of a project is zero, it necessarily means option A, internal rate of returns or IRR equals to discount rate considered. Option B is internal rate of returns is less than the discount rate considered. Option C is internal rate of returns is greater than the discount rate considered. And option D is internal rate of returns is equals to zero. So we have seen that what the internal rate of returns basically means. It is dependent on the time period, that is n, your present value PV, and your future value FV. So R equals to your future value divided by present value whole to the power 1 by n whole minus 1. It is the formula of the internal rate of returns. And the discount rate, it is basically your if the cash flow, that is there is a desired cash flow and there is a discounted cash flow. Based on the discount rate, the NPV actually decreases. So it is not desired. Based if the more the discount rate, the more the decrease of the present value occur. Though the rate of decrease of net present value still decreases. We will see a picture to understand this. So let's see first you are able to answer this or not. So you are telling internal rate of returns to be zero. So actually, I mean, it is not very easy to answer based on the just the question. So we will see a graph. So how the net present value of a project and how the discount rate basically related to each other. So it can be expressed with this type of graphs. So where the net present value is plotted at the y-axis and the discount rate is plotted at the x-axis. See, as the discount rate increases, the net present value gets decreased. So as I was telling, that the decrease is asymptotic in nature. So what basically asymptotic means? So it may be exponential, it may be asymptotic, and it may be linear. Linear means the graph is a simple line. The exponential means it is convex with respect to the origin, and asymptotic means it is your convex. Sorry, that will be concave. It is concave, and if it is convex with respect to the origin, then it is very asymptotic in nature. That means the net present value with the increase in the discount rate is decreasing, but the rate of decreasing is decreasing. That means asymptotic in nature. If the rate of decrease is same, so then the net present value decrease rate will be linear. If the rate of decrease is uh, your increasing, then it will be uh, concave with respect to the origin. That means it will rapidly decrease like that. It will rapidly become zero. Maybe here it will come to n zero. But generally, what happens? It is basically an example graph for you to understand. So, in most of the cases, after a certain time or after a certain increase in the discount rate, there is almost null decrease of the net present value. But anyways, the discount rate at which the net present value becomes zero is called as the IRR, or internal rate of returns. So the point at which the net present value becomes zero, as stated in the your question. So this point is basically your IRR point, or internal rate of return. So it is nothing but your discounted, but the discounted at which the net present value is becoming zero is defined as your IR. So that's why here in this case, in the computational formula of NPV, we have seen the formula earlier. It is equal to zero if the internal rate of return is the required rate of return. So that means your discount rate. So here option A is the correct because it is defined like that way only. It is the discount rate at which the net present value is becoming zero. That particular point is defined as your internal rate of return. So at this point, internal rate of return becomes equals to the discount rate considered, which is 40% in our case. I mean, in this example, it is not in the question. This is just for understanding. Okay, so if you remember the graph, then you can I think you can understand the relationship between them, between NPV, IRR, and discount rate. So it is basically your NPV versus discounted graph. It is shown like that way. In general cases, it is like that way. Some cases it may be linear, but some cases it may be exponential also. But mostly it is asymptotic in nature. Okay. So we will proceed. How it is the time? It is your okay. So I think the next MCQ we can take a 10 minutes break. Not 10 minutes, 8 minutes break we can take. At 7 o'clock we will proceed with our next MCQ. So I mean I also understand that whatever is being discussed in this class, so that is not very intuitive to me also. It is not very intuitive. So you have to you have to remember the formulas and you have to remember the plot. So if in the formula which we saw initially, if in that formula, if the values are given, then these graphs will come. So it will be plotted like that. So during I mean not also, I mean during solving problem also it will not get much clear, but still will solve certain problem and it will be pretty much clear. Not very intuitive, but still you will able to remember because the concepts are standard economic problems, or taken from standard economic formula. So this is not related to only water related projects. Also other kinds of projects. This payback period, the net present value, the concept of IRR, uh, the concepts and the discount rate also. All the concepts are basically your uh, standard economic theories, which because there are when there is one particular project and you are uh, desiring to expand your project, that is basically called as greenfield project, or there is a new project you want to for example, you want to set up a plant. You have got certain amount of land and you have to you are not going for capacity expansion, you are freshly establishing a plant. So that is called your greenfield project. So that may or may not be your water treatment plant. In all the cases, actually these economic evaluations are done. How much, what is your payback period? That means after you are investing certain amount, so after how much time you will be getting back the money you invested, just without considering your interest, the time value, the money value, sorry, your yes, the money value with respect to time without considering that. So just simply the cash flow. So if you are calculating the time period, so within how much time you are getting back your money that you invested, that may or may not be water project. So that is actually called as your payback period, and also other things we will see during solving the problems. So I mean And I mean, if you have gotten certain your more input on what I am saying, you can also add to that. You have got something extra to say, or maybe you are have some concepts earlier is not yet clear, so you can ask questions on that also. Otherwise, we will start 7 o'clock. We'll wait for 5 minutes, then we'll join at 7 o'clock. And thanks for joining. No other has joined yet in the first half, so only they will see the recording. No issues with that. Okay, so we'll join at 7. So I hope we are back. Today only one attendance will be there, I think. Only you. Okay. And what I actually consider during teaching, I think you are also, I mean, you're also doing PhD, so you will be professor also in the future, professor or lecturer. So what I believe, my personal opinion is that if certain class has got too many prerequisites, if there are so many, when every class must be independent of its own, there must not be too many prerequisites for any subject. So if it is so, then I mean those prerequisites at least which is minimum required for that class. So that must be discussed at the beginning. So if it is I mean, not so, if the student has to dependent on too many previous knowledge, I mean level knowledge, basic level of understanding, mathematical understanding up to 10th level is, I think each and every subject should be based on that. If we uh, just say that you have studied it, this formula you have studied, this concept you have studied in your plus 2 level or btech level, like that way, and based on that, if certain things are discussed, I don't think it is a ideal way of teaching. I mean, if certain formula pops up from somewhere else and the students don't understand how it came, so that's if the subject requires too many prerequisites or too many preliminary understanding of certain other things, then I think those must be cleared at the beginning of the session. If it is not clear and it is just told that you should have studied during your preparation of maybe JEE mains or JEE advanced or something like that, and it is just taken for granted, then I don't think it is an ideal way of teaching. But it is my way of understanding, my personal viewpoint. So I try to teach in or I try to present or facilitate the sessions in such that I mean it becomes engaging, and also it is mm, a bit clear from common sense or intuitive point of view. So otherwise, I don't think I feel it is very right to say that, see, those, I mean, it is obvious or it is taken for granted, or I mean things should not be presented in such a way that we assume many things students understand, so they know those things. So one should not, the teacher or facilitator should not, or teaching assistant should not assume like that they understand. So otherwise, and also it is NPTEL, it is on national level of thing. So I mean, from it is a highly recommended and highly required that we should discuss the things to, so that it is understandable to all types of students. So if I am not able to make that thing understandable or present those things in that way, then it is my failure. So I think this course is like that way, that Sarah also presents, I mean, in a very common way. So that, I mean, though the language is English, so English knowing is a preliminary requirement. So you can also, as I have told, so if the other people all joins the session, then they can ask. I know Bengali and Hindi, so you can ask in these two languages also, if you know this language. So otherwise, apart from knowing English, so otherwise the things must be presented in a very general way, so that it is the any section of any kind of and student of any merit can understand that thing. Okay, so we will continue with our next MCQ. So I think I have also seen SAR's lectures, and I actually becomes highly motivated by watching them, that this would be the ideal way of teaching. And also NPTEL, and also some one or two more courses of NPTEL I have taken. So these are very I mean, good. I mean the platform is very good. So in this way, the students can access world-class education from their home, and also in a very understandable manner. So most of the courses doesn't require much prerequisite. Okay. So the next MCQ is the following BCR assessment project should be accepted only if BCR is less than 0, greater than equals to 0, greater than 1, or less than equals to 1. This BCR we have seen earlier, it is benefit by cost. This ratio is benefit cost ratio, nothing else. So when we should accept a project, if the BCR of the project is less than 0 or greater than equals to 0 or greater than 1 or less than greater than, sorry, less than equals to 1. So basically what BCR means, it is hidden inside that. BCR means benefit divided by cost. Whenever a project is sustainable, that means the benefit involved with that project is obviously, yes, so that should be greater than your cost. So that means benefit by cost, mm, that must be your greater than 1. So when the BCR is greater than 1, then probably the assessment of the benefit cost ratio of a project is accepted. So even if in the question it is given as the greater than equals to 1, then also it is not sustainable. Otherwise, see, if the benefit or revenue becomes equals to the cost, that means the profit is 0, and no uh, less than equals to is not acceptable, and also equals to 0 is not acceptable. No business can survive if the profit is 0. There are, if for the sake of recording, I am telling, if some students are attending their that is called your placement interviews, and you are sitting for non-core jobs. For example, um, there are many business analytics companies who don't ask you questions from uh, your technical knowledge. So they don't check your technical knowledge. They check your business aptitude. So they will ask certain questions. For example, those are called as your guess estimates and case studies. So in the basic of each and every case study, this thing is there. So profit equals to revenue minus cost. Cost is divided into two parts: variable cost and fixed cost. And revenue is divided into a number of parts basically. But simply, if the company or project has only one product, or it has only one price range, then the number of products n into price of each product, that is p. So you have to increase the profit. That means you have to increase the revenue and you have to decrease the cost. So you have to analyze the individual component, the fixed cost, what are the associated fixed costs of the project, what are the associated variable cost of the project, what are the associated mm, uh, products. You should increase the number of the projects, or you should increase the price of the each product. So in that way, actually, in any business case study occurs, depending on the market scenario, depending on the application of data sciences. Actually, this thing happens. And also guess estimates, only they ask questions in based on these two types of aspects. And uh, what are related project is also not exception to that. Here also, your benefit must always be greater than your cost. That means BCR must always be greater than 1. If it is equals to 1 also, then also your profit is 0. That means your business is not sustainable. Okay. So option C only you have told, I think. Yes, it's correct. So now, which of the now true false? You have to identify whether the statements, following statements, are true or false. So statement 1 is the net present value based assessment of mutually exclusive projects of unequal lives should be done considering number of replacements that make the total project period under consideration that the total project period under consideration as same. And our statement 2 is NPV and IRR, which is basically your internal rate of return, may give ranking conflicts for mutually exclusive projects. Mutually exclusive project means mutually exhaustive projects. So these are independent projects basically. Exclusive means that only, I think. Yes. So the common part is mutually exclusive and collectively exhaustive. There is one term in your statistics. It is, the degree of independence is actually expressed with the help of this term. And here in this statement one, they are telling that the NPV-based assessment of mutually exclusive projects of unequal lives should be done considering number of replacements that may take the total project period under the project period under consideration same. That may make the total project period as same. Nothing else. Or it may give rise to ranking conflicts. So both are true or both are false, or one of them true, one of them are false. So you have to tell. Okay, Sanjay has joined. Good evening. So today in today's session we are just discussing about economic theories which are not only relevant to water economics, which is related to any type of industrial projects, either greenfield or be it brownfield project. So any type of projects, it is actually relevant. So I'll wait for 2 minutes to for you to answer the question. So in the option one, the IRR, the internal rate of return based ranking is not told only. Though we see that in NPP, the formula, the IRR term actually comes. We have seen in the beginning. I'd suggest Sanjay to go the recording when it will be uploaded, or you may go through these slides, or in the SARS lecture also it is discussed. uh, okay, so I'll wait for 1 minute, then I'll tell. Today I will not take much of your time. So the explanation is as follows. It is true that the NPV based assessment of mutually exclusive projects of unequal lives mean your time period of the project. The time through which the project is going, it will run for 10 years, then the life is 10 years, like that. Though the project is mutually exclusive, but I mean, both the project is mutually exclusive and their time is also unequal. So if you are doing assessment based on the NPV, then it should be done considering the number of replacements that make the total project period under the consideration as same, while NPV and IRR, that is internal rate of return, may give rise to ranking conflicts for mutually exclusive projects. That means your both the statements are correct. So if you are doing your assessment based on NPV and IRR both, then it may give rise to ranking conflicts between the projects. Ranking conflicts means you are unable to determine I should go with this proposal one or project proposal two, like that way we saw in the last class. So if you are doing your analysis based on the NPV or IRR, they are it may give rise to ranking conflicts. So that is what statement 2 is telling. Statement 1 is saying as that the as a NPV based assessment can be done for mutually exclusive projects of unequal lives, considering the number of replacements that make the total project period same. Okay, so both are correct, I think. Here, okay, so he has left, Swanja has left. Okay, now there is one MSQ, that is your multiple select question. More than one option may be correct. So generally the capital budgeting methods incorporate option A, tax effects, option B, time value of money, option C, required rate of return, option D, rate of cash discounts. So how many of them are correct answers? I feel very feeling bored because these questions, none of them are pretty intuitive if you don't know the meaning of what the things mean. So within just one go, you may not remember what terminologies are there. I'm getting one important call. I think, can I join after uh, this 7:18? Please give me. Uh, we will come with the answer. Please give me 5 minutes. I'll join after. I mean, at 7:25 I'll join. So please give me 5 minutes. Uh, I'll join after 6 minutes. I'll join. 7:25 I'll
Okay,
join.
okay, sir, no issue. Okay.
Restart the recording. Is 70. Oh, I am 2 minutes late. Okay. Thank you for patiently waiting. I don't know whether some people joined in the middle or not. Joined and left, maybe. So continue with our MCQ. I think I am loud and clear. Hmm. So where are we? Okay. So yes. So uh, capital budgeting methods incorporate which one of the following, or who all, maybe some of them, or maybe all of them. We'll look into that. So discounted rate will solve one problem on that. To get the concept clarified, the required rate of return, that is your basically IRR, or internal rate of return, or yes, internal rate of return. And then time value of money. This we have a tax effect means during budgeting, whether you are considering tax. Sometimes what happens, that investing in CSIR or some things, that means the taxable profit of that project. If the externalities are considered, if you are investing in some social things, or investing in some social benefit projects, which may not be directly related with your project activities, then the your the cost that is associated, or that means your tax that is applied to your taxable profit, so that actually your gets reduced. So depending on that, you have to budget how much amount of money you have to invest on your project, on your water project. So that means these are aspects. So whether all the aspects are incorporated in capital budgeting methods or not, so I think it is all of the aspects are involved. So tax effects, the time value of money, and required rates of return, as well as cash discounts, all the options are included in capital budgeting methodology. Because I mean, if you understand the concepts, yes, definitely all the above. If you understand the concepts behind the terminologies, then all the concepts should be included during capital budgeting. Okay, now we'll solve couple of problems, then we will end the session. So the last problem is a pretty lengthier. This one is a relatively shorter problem. So a project worth of rupees 1.5 crores of a mineral water bottling plant is to be established. If the value of the project is likely to be depreciated using straight line method for over 5 years with 35% salvage value, calculate the annual average depreciation of the project in lakhs of rupees. Now, what is the salvage value? Once the time period uh, for which the project will run is over, then still there are assets which are associated with the project, though the project activity is not going on. Still, it is not flowing. It is not generating cash flows value. Still, maybe if it is a plant, it is not running, but the equipments which the plant possess, that still has got some value. That is called a salvage value. If you buy a harmonium, and if you use it for 10 years, after that, if it becomes non-usable, still you can sell it in some lower price, very lower price. That is, it maybe if 10 lakhs is the cost of a let's say equipment, then after 10 years of its lifespan, then it value becomes 2 lakhs or something. But it may get zero also. I mean, it may be negligible also. That is called your salvage value. So uh, and the depreciation, here it is told as we saw, the net present value is decreasing earlier. That was not straight line, that was asymptotic in nature. It may be exponential, or it may be some random curves may be there based on the cost indices. As we saw in the cost indices, the costs are maybe increase or decrease with respect to time. But here it is clearly saying that it is depreciated using straight line methods for over 5 years. So after 5 years, whatever the initial cost of the mineral water bottling plant was there, the salvage value of that, after the 5 years, so the salvage value of the project is 35% of its initial cost. That is what they are telling. Now you have to just simply, as they are telling, it is straight line method, so you have to simply calculate the average annual depreciation of the project. So you can calculate it. If you are there, it is simple. It is just like simple interest. We have calculated in our +2 level. So it is simple like that. So if it was not mentioned as straight line, so the simple interest means straight line method only. Or if it was not mentioned as straight line method, then certain other, I mean, maybe whatever there are sum of year digits method, there are double depreciation method. So these are the complicated methods are there. So if those are mentioned, then we have to calculate accordingly, but here it is mentioned as a straight line method, so it is a simple just and there are two ways to calculate the solution of the problem. uh, what is the time now? Uh, okay, we'll wait for 1 minute, then we will with the solution. Then after that, we have to discuss one more problem, which is based on the your discount rate on the rate of cash flow. So this problem, it is very simple. So are there options? I think no, there are not options. Just you have to keep the units in mind. It is 1.5 crores, and the answer must be in lakhs of rupees. So the I mean, the salvage value is 35% of the initial cost. So it is 0.35 into this one, and if you just subtract it from the initial value and divide it with 5, or you may do like that way. 35% is a salvage value, that means depreciation is your 100 minus 35, that much percentage, and then that much percentage divided by 5 is your annual average, and then annual average percentage into the initial value, that will give you your answer, the lakhs of rupees. So we can go with the solution. Huh. So now the data given is your total value is rupees 1.5 crores. Salvage value after 5 years is given as 35% of the total value, that is your 52.5 lakhs, right? Yes. Then that means 35% into this. Now annual average depreciation will be 100 minus 35, that is 65 divided by 5, that is 13%. If you multiply 0.13 with the initial value, this value will come 19.5 lakhs. This is the answer. Or otherwise, you may do like that, same thing. You can subtract that 35%, that is your 52.5 lakhs from the 1.5 crores, and divided it with 5 years, your total number of lifetime of the project, after which the salvage value is given. The project may run for more years, then the salvage value will be less than 35%. Maybe it may run for 5 more years, and salvage value will come down to 12 or 13% of the initial projects maybe. So, but in our case, it is I mean, it is to be calculated over 5 years, so it is 9.5 lakhs, and acceptable range is within 17 and 22. It is the answer. Now we'll come to the main problem. So in this problem, you have to recapitulate the formula that we discussed at the in one of the initial slides. The relation between the net present value and the R, that is your percentage or rate of returns, or maybe in our case the rate of discount, which is as follows: NPV equals to n runs from 0 to n summation Cn divided by 1 plus Rn. That means C1 divided by 1 plus R to the power 1 plus C2 divided by 1 plus R to the power 2 dot 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 up to capital N, where small n is a integer, capital is in also an integer. The value of small n lies between it is more, I mean, it starts from zero and end at capital N, like that. If all the summations is actually basically your NPV or net present value, but when you are told to calculate the discounted rate or discounted cash flow, then what happens? The individual terminology is your discount rate of that particular year. So if you have invested certain amount of money at the year zero, then after 1 year, this will be your discounted cash flow. After 2 years, the second term, where n equals to 2, this will be your discounted cash flow for the year 2. Likewise, for third year up to the nth year. Here R is the discount rate and C is the desired cash flow for that particular year. Okay, so it will be smaller actually. It is same, smaller, capital R, same. Okay. So to total, if you sum total them, then it will come as the your net present value. Otherwise, up to if you sum it up to the total number of years, that is n years, sometimes it may run up to infinity, then the salvage value will be 0. But here it is a small n, it runs up to small n, which is less than your capital N. That means your total number of years, which may be infinity. Okay. So now we will solve a problem to understand this concept better. So, which is as follows. This statement is: a common effluent treatment plant or CETP is being established in a town with initial investment of rupees 20 crores that is expected to generate returns in crores of rupees as given below. So the initial investment, you have invested rupees 20 crore to establish a CETP. What is CETP? ETP, effluent treatment plant, is basically which treats individual which treats the effluent or wastewater of individual plants. Sometimes there may be small businesses, they may not be able to establish a robust treatment facility which is able to treat water to such extent which meets the environmental norm strictly. So they may not be financially that much strong to establish such plants. So sometimes what they do, some small business, they come together, they establish a common effluent, they put their individual money one by one, and they establish a common treatment facility, common effluent treatment plant or CTP. So they may have individual ETPs or effluent treatment plant in their plants, but from that outlet, the water comes into the common effluent treatment plant, which ultimately treats the water in such a way that meets the environmental norm. For example, I am currently in Mumbai. So in Navi Mumbai, I actually previously did some jobs. There was one organization in the Taloja area. There was one common cooperative of small businesses or small industries. They established one CETP in a cooperative way. So though the individual plants had ETPs, so still they are individually they are not able to meet the environment. I mean the BOD, COD level or pH level, or whichever is required as per the uh, Maharashtra Pollution Control Board or MPCB. So they may not be able to, they are not able to meet. So their water came to the, and also they are not zero liquid discharge plant. If that is a ZLD plant, then it is a different issue. So they may not be ZLD. So they actually had individual ETBs, and they had, with their individual money, they contributed a little bit, and they made a cooperative, and that cooperative established a CED. From the individual ETPs, water came into the city. So it is just like that. So if in a town it is established with an investment of 20 crores, and after at the zeroth year, so this is your capital investment. At year one, you have not invested anything. At the end of year one, that means 1 and 2 years have passed, then your investment starts. So these O&M investments is basically your operation and maintenance investments, and the returns you are expecting from this year onwards. So where n small n equals to your 2, so it is 3.8. So small n equals to 3, then expected return is equal your 4.4. So these tables actually your explains what is your initial capital investment, which is at the starting of the project, but you it is capital investment means like that way only. So in the throughout the years there is no investment, you are invested at the beginning. If some business partner is joining at the middle, then they may invest, but here it is not the case. Operation and maintenance cost is the cost which is required for running of the plant. That means your equipment may get damaged, or it has got certain life period. I mean, some individual equipment or parts of the equipment you have to replace. So or you have to oil those equipments. You have to operation is also, you have to keep operators, give them salaries. So for the those are all the operation O&M investments. So which it is not your initial investment, but it comes throughout all the years. And also it is generating profits, and we are seeing that the whatever returns we are getting, that is more than the O&M investment of that particular year. Otherwise, if the O&M investment of that particular year is more than the expected return, then the project will not sustain, because there will be no profit. Okay, so I think the table is clear. So now you have to answer the following questions. So this is the last problem. So it will take a bit time to discuss. So first you have to get you have to estimate the final payback period. You have to estimate the discounted payback period at a 10% discount. That means your R value is given as 10%, both in years. And then you have to calculate the discounted cash flow rate in the fifth year in crores of rupees. And number 4, you have to calculate the net present value at the end of the period of 8 years. That is, at this year, you have to calculate the NPV, net present value, in crores of rupees. So before starting solving the problem, I will again reiterate, and I will again want to clarify this concept. So this is the way with which you are calculating the discounted cash flow from a particular cash flow. You have got the 10% rate, and you have got the n value for individual years. In this, with the help of the value of R and N, you will calculate the DCF value for individual years from the respective cash flow rates. Now we will solve. Actually, I'll not tell you to solve this. I'll just go through the solution. So to solve the problem, we have to add 4 more columns in this table. So those columns are your net cash flows per year, cumulative cash flows, discounted cash flows, and cumulative cash flows. So basically, this cumulative cash flow is based on your net cash flows per year, and this cumulative cash flow is based on your discounted cash flows. Now, how we have formed the table? So up to the third row, that is your expected return, the OM investment, and your capital investment, all the three row data, and 3 into the 8 column, all the 24, the sales data are already given. You are calculating the rest of the 4 rows based on the data that is given in the first 3 rows. While doing so, we are considering return value to be positive and investment made to be negative. So why? So investment made means this amount of money is my liability, it is going out of my pocket, and return means this is actually fulfilling my pocket. So this amount of money is adding value to my pocket. So that's why returns, whenever returns is there, we are considering this as positive value. The investment value, that is O&M investment and the capital investment, all the first two rows we are considering as negative and the third row we are considering as positive while calculating the values of the other four rows. Okay, and all the units are in crores of rupees. Now you have to calculate the final payback period in years and the discounted payback periods in years, both in years actually, and discount rate is provided as 10%. So we will come into that later. So first we have to understand the table. How? So here the fourth row we have to calculate, it is your net cash flows per year. So in the 0th year there is no input of money in your pocket. You have invested 20, so the value is given as minus 20, so it is going out of your pocket. In first year there is no investment and no return, so 0 minus 0 equals to 0. In the second year there is no capital investment, but there is one O&M investment and you are getting return. So return minus investment is the money in your pocket, which is 3.8 minus 1 equals to 2.8. Like that, in third year your revenue is 4.4 crores of rupees and no capital investment, and O&M investment is your 1.2 crores. So your net cash flows that is coming into your pocket, that is 3.2 for the third year. So in this way, all the fourth year, fifth year, sixth year, seventh year, and eighth years net cash flows per year is calculated, which is basically nothing but your expected return minus your O&M investment minus your capital investment, which is basically your 0 from year 1 to year 8. So only 8.8 minus 1.9 equals to, it is coming as 6.9 for the 8th year, and also likewise for the other years. Now here it is stated as cumulative cash flows. What is this? It is what is your situation until now. That means at the end of 0th year, at the initial year, it is basically, it is a line. It is a 1 year. It is 2 year, 1 to 2. From 2 to 3, it is your entire year. So it is one, say first year, it is second year, and it is third year. So from 2 to 3 is your third year. So like that. So the gap between 2 points is basically your entire year. So at the starting, you have invested 20. So net cash flow is also 20. Cumulative also you're negative, because there is no return. At the end of first year, what has happened? So you are basically summing up this column with you are summing the return at the end of first year with the cumulative cash flow at the last year. So in this way you are adding. So 0 plus minus 20 equals to minus 20. So here minus 20 plus 2.8. So up to at the end of first year, your pocket was in you are in loan basically. If you have taken loan to invest this money, minus 20. So after the end of the second year, this you have got this return. So now if you have taken this amount as loan, then you have repaid the loan by 2.8. So that means your amount of loan has been reduced. This is the cumulative situation you are having currently. I believe you are getting it. So at the end of third year, again another return you have got, that is your 3.2, and your previous situation was like this way. It has been improved further. That means it is less negative. It is 3.2 minus 17.2. It is minus 14. Like that way, you are adding them corner wise. So in this way, you are actually getting the value of cumulative cash flows. So what is your current situation basically? Cumulative cash flow means like that. These are your expected return. I mean, all the values are your projected values. These are not the current. That's why actually your discounted thing comes. So I'll come into that later. So up to that, I think it is clear. So at the end of the first, whenever the at the sixth year, so your fifth year is over. So from 0 to 1, 1 to 2, 2 to 3, 3 to 4, 4 to 5. So here 5 entire years are over. You are starting your sixth year. At this year, you have gained some profit, but this profit value has exceeded your situation at the end of your fifth year. So that means now the amount that you are having in your pocket, that is positive. So from fifth year to sixth year, your final payback period must lie. That means at the sixth year, somewhere in between 5.5 and point 0.6, in between these 2 points, somewhere in between, your situation is switching from negative to positive. Somewhere in between is zero. So at that 0 point is basically your final payback period, or your payback period based on the net cash flows per year. Okay, so that's why in the answer it is stated as the answer is between 5 and 6. So what is it exactly? So it is 5 plus the amount of the time of the year when you are switching from negative to positive, which is basically nothing but your 4.3 divided by 6.5 into 1 year is there actually. Why it is coming like that way? So somewhere between 5 and 6. Why exactly 5.66? I think you are getting it. Still I will tell. So the thing is that you are in negative 4.3, and you have somewhere in between, you have throughout the entire year you are gradually, from 4.3 you are gradually becoming 2.2. So in between somewhere you have become from negative to positive. So this 6.5 has contributed to this negative value for you to become negative to positive. I mean, your situation to become from negative to positive. So that means how, in the 1 year, so actually there is a fraction of 1 year. So the fraction you are getting like that way. 4.3 is your negative contribution and is your positive contribution. So how much fraction of the sixth year you were in negative situation, that is actually calculated with the help of this fraction into 1 year, plus this entire 5 year through which you are in negative situation. That is entire timeline through which you are in negative situation. That is your actually final payback period. After that period, your situation is becoming positive. That means your entire your entire cost of the project, whatever you have invested until now, is you are actually gaining from this time. Actually you are starting to make actual profits. I hope it is clear. So in this way, the final payback period comes out to be this 5 year plus 4.3 divided by 6.5 equals to 5.66. Now you have to calculate the discounted payback period. I will come. How much time is left? Okay. We go. It is the last problem, I think, as I have wasted a bit time. I mean, I'll request you to bear a bit with me, bear with me a little bit to understand the what is discounted thing. So now after that it is your entirely positive. So I think the first problem is clear. So I will again, if somebody has got any problem, I will request them to post in the forum. So I will quickly tell what is basically your discounted cash flow. The thing is that your I mean, it is your ideal scenario, it is your expected return, but the thing is that in real case it may not occur. So they are actually telling that whatever cash flow you are actually desired, you are expecting to get, actually you will get 10% less cash flow than that in real case, as compared to the ideal case. So in that case, as I have calculated the net cash flows per year, from the net cash flow you have to calculate the discounted cash flow using the formula I described before. So which is your nothing but cash flow divided by 1 plus discounted rate to the power uh, the value of n, which is 1 in first row, first column, n equals to 2 in second, equals to, the thing is that these years are basically your n values. So now you you are calculating your discounted cash flows like this way. Excuse me. Just excuse me a bit. Extremely sorry. Just bear with me with 5 minutes. I'll discuss. Okay. Sorry about that. Hmm. So where are we? Sorry about that. Uh, I hope my screen is visible. Huh. So now, how we calculated discounted cash flow from the net cash flow? It is like that way. So using the formula that we discussed earlier, it will be the cash flow divided by 1 plus 10% to the power 2. The 2.4 came like that way. 3.2 divided by 1 plus 10% to the power 3. So that means your uh, one this is R is basically your 10%, that means 0.1. So the plus it will be 1.1, it will be 1.1, and end value will be that years. So your discounted cash flow will come out to be in the fourth case also it will be 4.3 divided by 1.1 to the power 4. In fifth case it will be 5.4 divided by 1.1 to the power 5, as it is 10%. So if it was 12%, if it was 12%, then it would be 6.3 this value will be 6.5 divided by 1.12 to the power 6, like that way. So 1 plus this 10 by 100 to the power the n. This is the factor with which you have to multiply the net cash flow to get the discounted cash flow values. So I hope, I mean, you are Ajim, I think you are understanding, but still, if I will request if for the sake of recording, if some people are not able to understand, they should raise the question either in the next class or in the forum. So if they raise the question, I will again discuss that how you are getting the discounted cash flow from the net cash flow. Okay. So now the rest of the things are just like the way you calculated cumulative cash flow from the net cash flow. You added them corner wise, like right. So you all also in case of the cumulative cash flows also from discounted cash flow you add them corner wise. So 0 minus 20 minus 20 minus 20 plus 2.3 equals to 17.7. So 2.4 minus 17.7 minus 15.3. Like that way, you will get all the values of the cumulative cash flow. So here we can see, in case of our desired cash flow, there was no, this discount rates was not there. That's why the payback period was a bit early. We got between 5 and 6 years. But as we, as the desired in real case, there is a 10% discount of the on the desired cash flow. You are getting lesser cash flow. So that's why your situation is becoming better at a later period of time. That means your payback period is more than the initial one. So you are becoming positive in between the at the eighth year. That means in between seventh and eighth. So that, and see, similarly, the way you calculated this one 4.3 by 6.5. Similarly, you have to at the switching point you have to divide this 2.1 with this 3.2 to get the fraction, of the eighth year for which you were in the negative half. 7 plus that fraction into 1 equals to it, which comes out to be 7.66, and in between 7.8 is your ideal value. And the last two questions which were asked, you are asked as the discount cash flow of the fifth year. You were asked, so discounted cash flow you have calculated for fifth year, it is straight away to 3.4. So you just mentioned it. There is nothing fancy thing. So you just whatever you calculated from the table, discounted cash flow for the fifth year n equals to 5. You just put the value which is there in the table, and then the last question is net present value at the end of the period of 8 years you have to calculate. So at the here a bit concept is there. Just give me 2 minutes. So at the end of the eighth year, uh, the net present value is how it is actually determined with the help of this formula. Discounted cash flows for 8 years minus the initial investment, which is your 20. So the amount of cash flow you accumulated up to the 8 years, which discounted amount of cash flow, which is your basically less than the ideal cash flow, which is nothing but your 2.3 plus 2.4 plus 2.9 plus 3.4 plus 3.7 plus 3.2 plus 3.2 equals to 21.1 minus the initial investment, which is basically nothing but your this 1.1. If If you are told to calculate the NPV at the end of period of seventh year, so actually the cumulative cash flow is here basically NPV. Cumulative cash flow depending on the discounted cash flow. So cumulative discounted cash flow is basically NPV. If it was told to calculate at the end of seventh year, it would be negative value 2.1. If it were told to calculate at the end of sixth year, it would be 5.3, like that way. So as it is told, you have to calculate at the end of eighth year. So it came out to be 1.1. Acceptable range is between 1 and 2. So I mean, sorry for the extra time I took. So I think so. One more session of Dr. Manoj Kumar Tiwari, who is the course instructor, is coming on the coming Thursday at September 21st from 3 p.m. Indian Standard Time, where you can log in this YouTube link and ask him live questions and interact with him live, or else you can log into this Google document link and you can type your questions there. So and Sad will answer either you ask live questions or you ask questions beforehand. Sad will answer the questions. Also, you can ask questions in the forum beforehand, because since Sad's last live session there has been no new question in the forum. We'll expect everyone to either ask question live or upload questions in the Google form. So and you can visit this link for updates on the further live sessions. After this, I think one more live session will be there. So if this session also, if you are having any doubt uh, on the your net present value, the way you calculate the net present value and the thing, if you have not understood it, either you can ask Sad in his session also, or you can ask in our next weekly session also. So both ways are possible. So thank you. I mean, if you Ajim, if you are personally, if you are having any question, or if you are unable to understand that, you can ask. I can redo that, but I will pause the recording after 1.5 minutes. So within that time, if you want to ask, or I can extend also. I mean, I can go further also for explanation. Otherwise, I mean, it will just take time. So if you just go to the slides and just go back and forth like that way, I think you will be able to understand the formula. It is following the formula, nothing else. So the last problem, I think it was clear because it was necessary for understanding the rest of the concepts. So I think it is clear. So if you are having question, you can ask. Otherwise, we will end the session after half minute. So otherwise, please attend the live sessions also. Also, people who will be watching the recording, I suggest you to attend the sessions live. And also, I request to attend the SAT session also, which will be occurring at the 3 p.m. on 21st coming Thursday. Thank you. Meet you in the next session. Okay, I'll pause the recording.